The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Reluctant or not, a record high is a record high. Live from Studio 2 here at Bloomberg headquarters in New York. I'm Romaine Bostick. We check in on the markets as we count you down to those closing bells. The S&P 500 setting up for its 26th record high of the year, 54th in 12 months. And right now it's on its strongest four-day run, going all the way back to April 2025. Of course, this does coincide with that drift lower in oil prices, which of course is tying up with that drift lower in yields. And oil is indeed the story once again. We want to focus on that because we are back on that downward channel from those March peaks, back down below that 200-day moving average, which pushed back down one-year inflation expectations to near two-year lows. The risk, of course, is that, well, we've been here before. That downward channel we saw back in early April, it did give way to a spike back to those near year-to-date highs by the end of the month. Similar story from mid-May to mid-July. And with the rhetoric from various players in the Middle East sounding the same as before, the lingering question right now surrounds the follow-through. Investors, though, well, they've learned not to look a gift horse in the mouth. And unlike recent past runs to record highs, this equity rally, much broader, sort of. Coming into today, Microsoft, Amazon, and Apple combined made up 65% of the point gain in the S&P since the most recent low back on June 10th. However, after that, the dispersion is actually relatively even. 337 names contributing over the past 8 weeks, including Visa, RTX, J&J, Coca-Cola, Home Depot, and DoorDash. That is breadth. Furthermore, the rally back to a record has been despite multi-week declines in Tesla, Micron, Oracle, SanDisk, Nvidia, and IBM. Now, curiously, though, the U.S. record run is being matched, if not outpaced by, of all things, Europe's stock market. Remember them? Well, they haven't forgotten. Europe, the only major region to have actually experienced meaningful improvement in risk appetite in recent weeks. The stocks Europe 600 closing today at a record high. The German DAX, the French CAC doing the same as well, all supported by fresh capital inflows on the back of way better than expected earnings.
I haven't seen such a strong earnings season in Europe in years. Earnings revisions breadth has shot up to the high teens. So the net percent of analysts upgrading their numbers is very high. It's higher than the U.S. now. If you look at earnings revisions by sector, almost every sector is now in the green, by the way, including luxury, which is unusual. And we have earnings growth consensus for this year. I think some people drop off their chair when they hear this, but it's 17%. I mean, Europe normally does 0 or 1%. We're doing 17% growth this year. Yeah. So we're seeing more interest in European equities, in part because of the strong earnings season.
And that sets up the global rally here as we move closer to the closing bells in the U.S. with Anaya Lodaya, portfolio manager of global equity over at Invesco. And Anaya, before we get to what's happening here in the U.S., I do want to get your thoughts about sort of the global nature of this rally. And I am curious, some of the gains that we've seen in Europe, is that tied to the AI race, or is it kind of divorced from that altogether?
It's hard to find pockets of the market that are entirely divorced from the AI race at this point. So much of what we're seeing in Europe is part of the AI race. Europe has several semiconductor companies that are fulsomely involved in the race. But on the flip side, Europe also has healthcare companies, which are one of the true pockets that are divorced from the AI race. And then part of the earnings upgrades that we were just listening to from the clip you played are also from energy companies that Europe has a lot of. So
give me a sense here, when we start to talk about, if not outperformance, certainly matching performance that we've seen in Europe and to a certain extent, even in some of the pockets of emerging markets, even if you exclude Korea in that, is that something that sustains itself for much longer, or is this just one of those cycles where people sort of discover that there is life outside the U.S. until they get scared about something and then they come right back to U.S. assets?
If you think that the AI trade is one that sustains itself for much longer, which I think most of us tend to think, although obviously there'll be hiccups and bumps along the road, absolutely what we're seeing in Europe, in pockets of Europe, and certainly in East Asia is highly sustainable. Much of the semiconductor trade is actually, the value chain is coming out of Korea, Taiwan, Japan, even the Netherlands. And those companies are really making hay while the sun shines. We've discovered as a world that some of them have bottleneck assets and not a lot of competition. So this has legs.
When we talk about legs overall to the AI race, there's been a lot of talk how we're kind of moving, investors are moving their attention away from just the companies that are sort of trafficking in the large language models, more to sort of physical AI and sort of the end use cases. Are you seeing opportunities there at all?
You know, with the AI trade, it's almost a game of, what Warren Buffett calls the manic depressive market, where Mr. Market wakes up every day in a different mood. And so overall, you see the market keep moving from the LLMs to the physical trade to bottlenecks. But essentially, the market there is method to the madness. And what the market is trying to do is figure out the one job that the market has always had. What is the core earnings power of this business model, and where does the value accrue? And the data points are coming in so fast and so furious that it seems to change on a daily basis, and it can feel manic and it can feel volatile, but that is essentially the journey that the market is on.
Did this earnings season, which still isn't over, but has it given us any more clarity on what that earnings power is?
Yes. So the whole AI trade, the first cliffhanger is will they, won't they, as far as the hyperscaler capex goes, right? God forbid that they scale it back as far as all the bulls are concerned. And so this earnings season definitely gave us clarity that hyperscaler capex continues. It also gave us some clarity that the market is beginning to sift through winners and losers and is appropriately punishing companies where the free cash flow is questionable and rewarding companies where there's free cash flow. And so we have clarity that the trade continues. And increasingly, we're getting clarity around who the winners and losers are. Where are the bottlenecks? Where aren't the bottlenecks? What the market is constantly grappling with is, a bottleneck only exists till new supply comes on. So that's where some of the volatility is, below the level of the hyperscalers and the core players.
Are there any concerns, looking at the economic picture and more importantly, the macro and yield picture, are there any concerns about that if the cost of capital does materially increase, that sort of disrupts the AI trade? I know we had a little bit of a scare last week when yields here in the U.S., long-term yields spiked, although they've subsided a lot, primarily because of the drop in oil prices.
Historically, all big bull runs have come to an end with the Fed pulling away the punch bowl and raising rates. But in this case, there are a couple of nuances. First of all, let's just say the Fed increases rates by 25%, even 50%. Is that enough to stop hyperscaler capex? The consensus view, and I agree, is probably no. Because if you can see returns on invested capital for the hyperscalers on that investment, the markets are supportive. They will continue to probably invest. And then macro is always important. If something breaks in the macro, then all bets are off. But right now, it's the micro driving the macro, right? It's the AI minutia of hyperscaler capex, bottlenecks, spend, etc. That is more preoccupying equity investors right now than interest rates per se, as long as we stay in even bands.
As long as we stay in even bands. Do you think that's going to continue for a while, where we're at right now?
The consensus view is that the Fed hikes into the end of the year, but I think we have a few data points and a lot of wood to chop before we can be sure of that. Every day the headline changes around what's going on in the Middle East. That impacts oil, that impacts the cost of capital. So we'll see. But right now it all looks like walls of worry that are not insurmountable, that the market will probably climb. So equity investors are definitely much more focused on the spending in the AI right now.
All right, Anaya, great to have you here on the program. Anaya Lodaya, portfolio manager of global equity at Invesco, kicking us off to the close. When we come back after the break, we're going to talk about the big deal and a cultural collide in the world of creator-driven media. Richelieu Dennis, the founder and chair of the Sundial Group, joins us in just a second to talk about a key strategic investment. And from culture to horticulture, ScottsMiracle-Gro has a new growth algorithm. Its CEO, Nate Baxter, just coming off the heels of his investor day. He's going to stop by the program here to tell us what he had to say to those investors. And after the bell tonight, we're going to hear from SpaceX. Full coverage of the company's first earnings report as a public company. We're going to hear from former Tesla board member Steve Wesley, former Harvard researcher Sinead O'Sullivan, as well as Ross Gerber, and so much more. Stick with us. This is The Close on Bloomberg. The media landscape shifts and some folks try to keep up. Earlier today, we sat down with Richelieu Dennis, the founder and chair of the Sundial Group of companies, as his brand, Essence Ventures, makes a strategic investment in Offscript Worldwide, the parent company of Revolt. Now, the move brings together two storied brands in a play to boost scale across several generations of audiences. Here's what he had to say.
the beauty of the brands that we look at are they have to be brands that have a cultural resonance and value to the communities that we serve, right? So there has to be deep trust, has to be authentic, and it has to have the what we like to call the North Star, right? And that North Star for us, that North Star is, can you use a business to develop a community, right? And does that fit within our framework of community development? And so as we look out beyond sort of what's happening in the next 12 months, 18 months, but looking out to say, okay, what we need to have 50 years from now, what can be relevant 50 years from now, what can drive economic value 50 years from now, as well as cultural value and heritage, Revolt stands out. And what they're doing at Offscript, we love.
Well, give me a sense here. When we talk about culture, obviously Essence is an iconic brand that I think every black family, certainly every black woman had on their coffee table back in the days. That brand has extended to a new generation. Revolt kind of came about after the fact, speaking to a newer, younger generation. Yes. What's the thread that combines those two?
So the thread for us is multi-generational, right? We look at, like I said, we're looking 50 years out. We want brands that are here 50 years out. We want to build businesses that are here 100 years from now. So multi-generational becomes a big part of that strategy, right? And so if you take a look at Essence, right? Essence is now truly a multi-generational brand, right? You go to festival, you see it in person. You look at our data, you see it in the data, right? We're truly serving multiple generations, right? With that brand, with the content, with the festival, all the experiences there, right? Revolt is now on its second generation, if you will, right? Whereas Essence is probably pushing on its fourth generation, right? And so we like brands that have that type of staying power, right? In addition to that, where it fits in is, Essence, women, right? Refinery 29, women. Women are driving the economy. They are making the decisions in the household. They are influencing. But what Revolt has are the men that they care about, right? And the men that care about them. And so what we're now able to do is to offer to the entire marketplace a sort of nucleus around youth culture, multi-generational youth culture, and then underneath it all now infrastructure and scale.
Essence Fest, one of the biggest festivals out there. Huge economic impact for the city of New Orleans, where it's been held now for, 30 years or
32 years.
32 years or something. But I know the contract with New Orleans is over. There's been some talk as to whether Essence Fest will actually return. When you have quantifiable economic impact in the hundreds of millions of dollars, why is there a debate about whether you'll be back?
No, I don't think the debate is whether or not we'll be back. Or let me rephrase that. The debate is whether or not we'll be back in New Orleans, right? So we just had festival July 4th weekend. 505,000 people showed up, according to the papers in New Orleans and the people that are keeping the data there, right? We had 50, 60,000 people come through the convention center a day, free, right? Over 460 hours of programming for those people that came by, free, right? The economic impact is tremendous with our partner hotels. We're running 95 plus hotel occupancy in the middle of summer and one of the hottest weekends of the year. So we're driving a tremendous amount of economic impact there, and we're working with the city so that we continue to do that and we continue to grow, right? It's not. The question isn't whether or not Essence will be back. The question is, hey, will it be back in the city of New Orleans?
Do you think it will be back there next year?
We are working like hell to make that happen, right? We're going to work because our community deserves what it is that we bring to market. And New Orleans has been a partner for 32 years. They've been a good partner for 32 years. While we've seen investments shrink, right? We certainly expect that we will be able to come to terms and continue what we're doing. But we're excited about next year.
I am curious how you merge and sort of how you balance out the content creation side of the business, the live event side of the business, and everything that goes in between. I know you didn't disclose details, financial details of the deal with Offscript. Do you want to disclose them?
No.
Okay. But give me a sense here, because I mean, you bought Refinery, obviously you bought Refinery 29, obviously Essence. I mean, is the return, the potential return that you get off of this partnership, this minority investment in Offscript, is that going to potentially be as accretive as those other deals that you've made?
So I think so, because what we're now able to do is to bring infrastructure together, bring capabilities together, and as I said earlier, drive that scale, right? So we're excited about the opportunity to be able to do that. And I think one of the other things is we don't need to own everything, but what we do need to be able to do is to be able to access everything. This gives us the access that we need. This gives us a great team over there to work with, alongside our great team over at Essence. We now have the opportunity to merge our inventories, our product, to go to clients with bigger offerings and better offerings. So that's very exciting. And the other thing for us is it's also important that these brands that have been driving our culture are here when we're not here, right? So we're also looking at it through those lenses.
That was Rich Dennis, the founder and chair of the Sundial group of companies, talking about his minority investment in Offscript. And you can catch the full interview by going to Bloomberg.com/videos. Now, when we come back, we turn back to the public markets and take a closer look at McDonald's. Out with its earnings report today, it beat on several metrics, but a bit of a slowdown in same-store sales growth. We're going to catch up with Mizuho's Nick Setyan when we come back after the break to get his assessment of what might come next. This is The Close on Bloomberg. Time now for our top calls, the big movers on the back of analyst recommendations. We start off with Nike. JP Morgan, which cut its overweight rating to neutral 4 months ago, today downgrading again, this time to underweight. The analyst saying Elliott Hill's win now turnaround strategy taking longer than anticipated and will continue to weigh on finances beyond this year. The shares, which rallied 2% yesterday, giving pretty much all of that back today. Next up, Palantir. Deutsche Bank upgrading after Palantir's quarterly results and full-year forecast came in ahead of estimates. The analysts there saying Palantir operating several steps ahead of the rest of the software space and converting AI demand into real customer value. Those shares up 30%, their best day going back to 2024. And we're going to end with Walmart. Oppenheimer downgrading to a neutral equivalent on what the analyst says may be a second quarter comp sales number that could miss street expectations when the retailer reports in a couple of weeks. The $440 price target being removed. The shares, though, up slightly on the day. And those are some of our top calls. Another stock we're watching is McDonald's. They open higher but have been drifting lower as the session goes on. The restaurant chain did beat on several key metrics and named a longtime executive, Sky Anderson, to take over its U.S. business. This after posting the slowest U.S. comp sales growth since the start of 2025. Nick Setyan joins us right now, Managing Director and Equity Research Analyst covering the restaurant sector over at Mizuho. What was it, like 1.3% comp sales overall, 0.8% here in the U.S. Let's talk about the U.S. business. That's a considerable slowdown from where they were the previous 3 or 4 quarters.
That's right, and more importantly, you talked about July, that was slightly negative. And so they're clearly a traffic share donor within an industry, and it comes down to having a relative value problem. So, pre-COVID, they were clearly the value leader, and I think they've lost their way a little bit. They're trying to figure out how to get back to being the value leader, and it's a tough road.
Well, it's a tough road, but here's what Chris Kusmanski said on the conference call. He said that they were hurt by inconsistent execution across its restaurants, saying we don't have a strategy problem, we simply did not execute. Do you buy that?
Well, they didn't execute, and the franchisees, about a third of their franchisees didn't buy into the under $3 menu. So meaning they just didn't want to lower prices.
What is McDonald's these days? Because I think in the past, a lot of people looked at McDonald's as a value proposition. And I know there's been a lot of hay made online over the past few years about the cost of a meal at McDonald's, certainly relative to, as you're alluding to, some of its competitors. Are they trying to be a value play, or are they comfortable going up in terms of the income spectrum, if you will?
I think they're trying to have their cake and eat it too. So they're raising prices another 3 to 5% this year, and that's
because they want to, or they have to.
They have to. Franchisees, they can't control franchisee pricing. Legally, the franchisees can take as much pricing as they want, and what they're dealing with is beef inflation. They're dealing with labor inflation. So they're trying to protect their margins as much as they can. But at the end of the day, that's a lot more pricing than fast casual or casual dining is taking, which is why casual dining is winning at the moment. And at the same time, they're introducing value offers, value offer points, and they're trying to get the franchisees to be on board. But like I said, a third of the franchisees did not participate in the under $3 menu rollout in April, which was one of the execution issues that they pointed to.
So what does Chris Kopensky and his team sort of articulate in terms of how they can maybe get comp sales back up to something that's a little bit more commensurate with what we had seen for the previous year and a half or so?
Well, I think they're trying to focus on value. I think I think the word they used was emergency. And so I do think we're going to see a lot more digital offers. I think we're going to see a lot more advertising and social media focus on value.
But that came up on the call, the idea that he seemed to think, the CEO seemed to think that maybe they didn't quite sort of take advantage of advertising in the way. I wasn't quite clear what he meant. It didn't seem like it was more advertising. It was like he just wanted more effective advertising.
Well, I think there's two parts of it. I think one of it was he mentioned awareness of the under 3 menu, and I think they underperformed expectations regarding the FIFA sponsorship. And so on both of those accounts, I think that there was poor execution. I am guardedly optimistic that as we go into Q4, we'll see more effective advertising, particularly under this new management team. But at the end of the day, I think this isn't necessarily a marketing issue. I think it's a value perception issue.
All right, Nick, great to have you here. Great to have you on set.
Thanks for having me.
Nick Setyan, one of the best in the business, managing director and equity research analyst over at Mizuho. A closer look at shares of McDonald's, still in the green, up by about 0.3% here on the session. Now, as we move closer to the closing bells, we're going to take a look at another company, ScottsMiracle-Gro, turning over a new leaf. The company's new CEO, Nate Baxter, in town for an investor day. He joins us next, right here on The Close, right here on Bloomberg. 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick. And as we count you down to those closing bells, we want to take a look at gardening product maker ScottsMiracle-Gro, unveiling new growth targets in its investor day today. Fresh off a new CEO appointment, the company says the adjusted EPS and sales targets are part of a, quote, growth algorithm with legs into 2029. And to put a finer point on that, the company putting out those mid-range financial targets for fiscal 2027 through fiscal 2029, average annual adjusted EPS growth of 5 to 8%. Fresh off that investor day, right here in Studio 2, is the CEO and president of ScottsMiracle-Gro, Nate Baxter. Great to see you, Nate.
Thanks for having me.
I know you're getting settled into the job. You had to come talk to the Wall Street hordes. How did they treat you today?
Everybody was great.
Yeah.
The reality is I've been having conversations for the last 18 months with our investors. So while the title has changed, the underlying strategy is still consistent with what I've been talking about for the better part of 2 years.
Well, let's talk about the underlying strategy. When I see EPS growth of 5 to 8%, that doesn't seem aggressive, but it's not necessarily low either, given all of the complexities going on in the world today. What gives you the confidence that you can meet that?
Well, we do recognize it's sort of conservative. It's sort of in the sweet spot of a value investor. If I look at the last couple of years, we've had a lot of volatility in the markets, a lot of events between tariffs and the war in Iran that we just couldn't predict. So our point of view is we're going to be fairly conservative, but we are going to turn into a growth company. We believe that the underlying initiatives that we outlined today are going to get us to where we need to be. But we also wanted to be honest with investors about growth. I told the team, I think we can outperform that. But our focus right now, especially from a capital allocation standpoint, is getting that leverage down a little bit more.
So with regards to the growth strategy, and forgive me, I don't mean to be flip about it, but when I think about the products you sell, obviously iconic brands, the branded products, but that doesn't seem like a growth story, unless I'm missing something.
Well, I think you have to look at it a couple ways. So we do believe there's a lot of organic growth possible. Our average household penetration is only about 10%. So if you look at the 85 million households out there, only being penetrated by 10%, we have a lot of organic opportunity. Now, the question is how do we convince consumers to engage with us in our category? So I think that's one of the fundamentals. The other is that we know channels consumers are shopping in channels that they didn't before. You know, you come out of the pandemic, I think we had something like less than 5% of our total point of sale that was through e-commerce. Now we're up to 13%. 300 bips alone this year. So what we're realizing is we need to go to where the consumer is, especially the younger consumer, and they're in totally different channels.
Well, talk to me a little bit about that, because what is sort of, I mean, you talked about this at the Investor Day, you talked about this on your earnings last week, I believe, as well, about digital advertising and your approach to it. What does this mean? You're just making, like, you know, funny things on TikTok, or is it a little more sophisticated than that?
No, I mean, we certainly don't want to cheapen the brands. It's more sophisticated than that. What we're recognizing is we need to meet the consumer where we are. You know, we used to be a traditional media company. You would buy those upfronts. You would have a fixed date. The cost was sunk. You would run it. The weather might not be great. Not necessarily the right way to do your media strategy. So we've now pivoted where 80% of our media is digital. And it does two things that are really important. One is we get to tailor it for individual consumers. And the second thing is we get to be really agile with it. We can decide on a Monday, if the weather is not going to be good in Chicago this weekend, we can pull back or we can redirect it. So it allows us to be much more effective. And we've seen a commensurate increase in the media ROI as a result of that.
Is your marketing primarily created in-house, or are you relying on third-party agencies?
It's a hybrid. We have for the social stuff, we like to do it in-house because you need to be able to respond to what's happening out in the world. But we have a whole bunch of partner agencies. We don't do the traditional AOR, you know, model. We actually pick a lot of partners and we let our people sort of direct. And it's been hit or miss. You know, we've got great agency partners. We have some that are good for a period of time and then we want to move on. But one thing, it's a little bit like AI. It's changing so quickly. We've got to be flexible with who we partner with on these initiatives.
Talk to me about your input costs. I mean, we've seen commodity prices up, including for urea. Obviously, it does not seem like there's going to be an end in sight right now for those to come down with regards to the situation in the Middle East, as well as some of the other weather-related factors. How have you factored that into that 5 to 8%?
So yeah, certainly been a challenge. I mean, I think we talked about in our Q3 earnings, we had a little bit of a headwind this year. We absorbed most of it through cost out, but about 15 million of it did fall to the bottom line in Q3. For next year, we're doing a few things. One is we've got a great team that does pretty sharp hedging, and so we do hedge urea, diesel when it's available. But more importantly, we work on how to minimize those inputs, and we're also going to have to take some pricing this year, and that's a delicate balance. We've got to look at volume trade-offs with that, but we have great relationships with our retail partners, and given we're in the mid-single-digit range of pricing, we think we can figure out a way to navigate that.
What's the relationship like with the retailers and where you put product versus what maybe you're trying to sell directly through your own channels?
Well, let me be clear. We don't really endeavor to sell a lot directly through our own channels. It's a pretty small, it's a rounding error for us, and it's not something we're focused on. Our lawns program is the biggest, but our retail partners are pivoting very quickly to e-com. So if you look at the big three, which is what we've traditionally talked about, footsteps in those brick and mortar stores, flat to down. Actually, last quarter they were slightly positive, which was a great sign to see. But they are pivoting quickly. So we are now in the mode of developing products for all of our e-com consumers and retail partners. And that's a big part of what we talked about today, which was innovation.
I do just have to ask you, obviously, when I think of the products that you sell at ScottsMiracle-Gro, I think, you know, you're a homeowner. You're going out into your backyard or into your front yard and applying the products here. We know that the home ownership rate has gone down. We know the turnover of homes has gone down as well. I assume that has to have a direct impact in your business. How do you compensate for the slowness that we're seeing in that space?
Well, the good news is it's all part of how we go capture that next generation. So that next generation, they are not yet homeowners. They are apartment dwellers. They have condos. So we've pivoted hard into indoor gardening, something we've always done, but we haven't talked about it. And we had a whole new suite of products that came out. The other big win that we talked about at Investor Day today is in the grocery aisle. We typically have not been present in the grocery aisle with our controls products. And so we now are winning business at some of our bigger partners in the grocery aisle. That's a big deal for us. And then if you look at our partnerships, we've talked about a partnership with a small company called Murphy's. They're doing on-skin, natural mosquito prevention and repellent. We're finding new channels with them. So I think, you know, this growth story, just to go back to what you asked me a minute earlier, it's really about getting the right products in our consumers' hands. So we've got our traditional consumer that likes the traditional product that you just mentioned, but we have the next generation consumer. They want natural, they want organic, they want things that are safe for pets and kids. That includes apartment dwellers. That includes people that aren't yet homeowners. And when I look at the homeownership, I don't look at it as a headwind today. I look at it as it's going to be a tailwind when that dam breaks and we start to see more turnover in the homeownership. So we We don't look at it as a negative. We just know that there'll be something down the road coming where we can engage that next-gen consumer as they become homeowners.
All right, Nate, great to have you here.
Thank you very much.
Nate Baxter there. He is the CEO and president of ScottsMiracle-Gro. We do have some breaking news, this involving SpaceX and Nvidia. SpaceX saying that it's partnering with Nvidia. After all, who isn't? SpaceX basically saying that it is partnering with Nvidia to design a satellite compute payload, and says that the Starmine satellites will include Nvidia's Rubin GPUs. And just an update, of course, SpaceX does report after the bell tonight, so maybe we'll get some more details on that. You see the move higher there in SpaceX now, up about 9% heading into that print. When we come back, we're going to check in on some other stocks that have been soaring. This on the back of a report that the Trump administration is aiming to protect U.S. data center infrastructure. It's putting a big bid under a lot of big stocks, including Corning, Lumentum, and Coherent. That's our stock of the hour, and it's coming up next, right here on The Close, right here on Bloomberg. Time now for our stock of the hour, and we're looking at a whole basket of optical equipment makers. That includes Marvell, Corning, Cisco, and Ciena, all rallying today after Reuters reported the Trump administration is drafting a ban on data center components imported from China. Bloomberg TV markets correspondent Nora Melinda joins us right now to talk a little bit more about this. And obviously, we're talking about some very specific components. First of all, let's start with this Reuters report. What exactly do we know about this ban or potential ban?
Potential ban, right. So we do know that China has essentially dominated this space. We've been seeing all this attention on AI chips, but you also still need to talk about the optical component that goes into it, and that's how these chips are actually able to communicate with one another. Now, if China's kind of been dominating this space, the U.S. is, of course, really concerned about those national security concerns that we've been talking about in many areas. But separate to that, also the AI race and us essentially trying to get ahead of China. Now, Wall Street is still a little bit skeptical as to whether or not this will actually pan out, being that China has been a leader in this space. And it would take a lot to actually see this come to fruition. But as a result, we are seeing a lot of those U.S.-based companies rallying on the idea that they could potentially take market share from some of these Chinese-based companies.
Well, market share, assuming they have the capacity,
right.
And I assume prices go up. And last time I checked, prices to build out data centers are already pretty high. We were listening to companies, and one confused me. So you got Corning, Coherent, a couple others I'm forgetting. Marvell. I'm confused. Do they make optical equipment?
Well, that's one I had to dig into a little bit. So this one actually does not actually make optical components, but where it could potentially benefit is due to the demand for those optical components. So essentially, it does supply many of the networking chips that power AI data centers, and that's the way that they essentially are weaved into this rally here. So stronger demand for optical infrastructure more broadly will essentially also help support Marvell's broader networking efforts and capacity there.
I just want to say the Chinese embassy in the U.S. responded to this report and urged Washington to, quote, listen to the objective and rational voices of the business communities in both countries. And it goes on, blah, blah, blah. But this does get the idea, and I don't mean to be glib about it, but this idea that right now we're already facing a lot of supply constraints when it comes to the components and other things needed to build out these data centers. And now we're adding potentially another cost there. I know investors, why the knee-jerk reaction would be bid these stocks up.
Right.
But what confidence do they have that this stuff will get bought? At some point, there's got to be a price ceiling that the potential customers are just saying, you know what, this just isn't worth it.
Well, that's the question, because there's a bit of a push and pull. And we've been talking so much about affordability and whether or not these companies should be taking on the amount of debt, the amount of cash that's needed to actually see the AI build out into fruition. But I mean, we have also seen Nvidia making a bet on this. They did actually invest about $2 billion in Lumentum and another name in the space. So maybe if Nvidia is backing it, co-signing it, it also gives investors on Wall Street some sort of hope that this is something that is worth betting on if you think about the idea of how you can really squeeze out all that you can get out of this AI trade.
Nvidia co-signing a lot of things these days.
Right.
In fact, just before you came on the air, we were talking about apparently now, you know, SpaceX and Nvidia have a partnership. And I mean, not to get too off topic here, but we are going to hear from SpaceX later tonight, which, depending on who you believe, is either a rocket company or an AI company. I think Elon Musk would say we're basically an AI company, and at some point we'll have our data centers out in orbit. Is there a sense that investors are still willing to embrace the AI trade wholesale? Or are we at this stage now where it really is just everyone's just parsing it and picking and choosing?
Well, we are seeing investors being really choosy, specifically when they're thinking about what areas of tech that they want to invest in. It feels like every single day we're getting a bit of whiplash when we're seeing a rotation out of tech and then also just a bit into some of these more individual sectors within the tech space. But I mean, SpaceX, of course, is going to be one of those earnings reports that everyone parses very, very carefully, given the fact that this was the biggest IPO of the year. This is their first ever quarterly earnings report. But also the stock has really been on a roller coaster ever since it IPO'd. So there's a lot of things that investors will be digging into when we take a look at this report that comes out later this afternoon.
And we'll be digging into that right here on The Close, right here on Bloomberg.
SpaceX, in our view, sort of has almost a bit of an identity crisis. If you think about it, they have so many different parts of the business. And for us, the crown jewel is really the launch piece of the business. Without the bottleneck rocket capability, it's difficult to think of the connectivity business being available. The AI orbital data centers wouldn't even be a topic of discussions without it. And then when we think about valuing a business such as this, you have the piece that we call the known knowns and known unknowns.
A lot of focus on the various components of the SpaceX business and how it all gets put together. Julie Zhu over at MoffettNathanson yesterday making that point as we await their earnings from what was the largest IPO of the year, and more importantly, less about the earnings and more about how Elon Musk is going to communicate his vision for this company, particularly with the stock trading below its 135 IPO price. As for the rest of the market, we are setting up for record highs for the Dow Jones Industrial Average, and more importantly, for the S&P 500, 7748 and change, up about 2% right now. This will be the first record high for the S&P since June 2nd. A decent bid coming into SpaceX heading into those earnings, but a big part of the reason why you're seeing some of the optimism around the broader market, it's sort of threefold. One, of course, it is some of the earnings that we've gotten that have provided a big boost to sentiment, but also this downdrift that we continue to see in oil prices, NYMEX crude below $76 a barrel, and that is putting downward pressure on yields as well. Right now, your 30-year yield camped out at just under 5.2%. Let's bring in John Belton, portfolio manager and managing director for growth portfolios at Gabelli Funds. And John, I do want to talk a little bit about some of the earnings that we've gotten so far and to kind of put them into context as to where we stand with regards to sentiment around the AI trade and this big tech trade. It seems, at least as of late, the bigger beneficiaries in this market have been the hyperscalers, or at least some of the hyperscalers, who have kind of shown some degree of proof of life that, yeah, there is indeed a return up ahead for all of this CapEx investment.
Yeah, and I think that's what you've been seeing kind of propelling the market the last couple of days. To your earlier comments, yes, there's been some potentially positive news yet again in the Middle East, subject to change. But what's really changed over the last couple of days for the tech trade or in the tech tape has been hyperscaler earnings from Microsoft, from Amazon, and I even think from Meta as well have been really positive on a number of fronts. And, you know, those bellwethers, I think all the doubt that existed about kind of the AI CapEx cycle, at least for now, I think the market's become more comfortable with things.
So how are you kind of valuing things right now, John? Sort of when you look at sort of what the potential ROI might be on that CapEx spend for something that maybe you hold in your funds, are we looking at it too narrow? Is it just simply, okay, when it shows up in the bottom line on EPS in some way or in margin expansion, or is there some nuance that maybe folks should be looking to?
I mean, I think every company here is different, right? I think you've got companies like Meta and Alphabet where AI infrastructure is clearly helping accelerate their core advertising businesses. So for those companies, this is a story of revenue acceleration and under that margin expansion. And it's really been earnings acceleration that this AI infrastructure has been driving. So you can look on a backward-looking basis and just calculate what's the ROIC been for these businesses over the last couple of years, and it's very, very positive news. I think looking forward is really what the market is starting to question. Given the size of the CapEx aspirations over the next couple of years, are they going to be generating similar returns moving forward as they've generated over the last couple of years?
I'm curious how you look at a company like SpaceX. There's been obviously a lot of hay made about its multiple 400 plus times forward earnings, 26 times sales. I understand there is sort of this kind of Elon Musk lever, the idea that a lot of people believe he'll pull a rabbit out of his hat one way or the other and make good on some of these promises. But when they report tonight, are we looking at this as a space launch company, as an AI company, as something in between? What?
Yeah, it's a unique company, so I don't think it has to fit any sort of predefined definition that you'd think of for a different company. It's a totally unique company. I think when I think about SpaceX, I think there's sort of two relatively mature businesses as things stand today, or two businesses where you at least know what they are. The launch business and the connectivity business, or Starlink. And I think you can kind of pencil out what do the earnings look like for those businesses over the next several years under a set of assumptions, and sort of get to some, idea of what those businesses can generate in earnings over time. The AI segment, I think, to me, is still the earliest, the most nascent. We still don't know what sort of shape that's going to take. There's a couple of different pieces under the hood. So going to be interesting to hear tonight how they sort of frame all the moving pieces for that business.
Is there a sense here that when we talk about what Elon Musk might be trying to do with this company, and let's just set aside the rocket business because that obviously has a singularity to it that is unmatched. But at least on the AI front, I mean, he's kind of late to the party. I mean, everybody is trying to build data centers. I understand he's looking more at the orbital side of this here. But does it matter that he might be a little bit late to the game?
Well, that I think is the key question, because I think, within AI, again, there's a lot of moving pieces. There's a lot of different pieces, I should say, but Grok, and I think Grok's ability to penetrate this large enterprise AI market is key for the stock. And that does seem to be an area where they are, to use your words, a little late to the party, clearly behind Anthropic, OpenAI, and Google as well. So he's going to have to talk about how he plans on catching up there. But they have demonstrated some core competency in other areas of AI. So like these Colossus data centers they've built, the speed and complexity at which they've built those facilities and brought on a ton of compute. I think they're now approaching 2 gigawatts of compute there. So they have demonstrated some real capabilities and competency in that area of their AI business on the infrastructure side.
So are you comfortable, John, kind of where we stand right now in this AI space? I mean, just before you came on, Nvidia, we learned through SpaceX that they're partnering with Nvidia. Nvidia's partnering with everybody. There's been a lot of talk about the circularity of these various investments and deals. And, are we just kind of passing the buck around? Or is this sort of a genuine sort of ecosystem, a genuine flywheel that is going to sort of benefit everyone involved, or most people involved?
I think it's best to look at this from a high level and just think very simplistically, what is the utility of AI technology? What is AI good for? We know today AI is good in digital media or digital advertising. We know it's good in digital commerce. I think that seeing the use cases broaden out from there is going to be key for the AI trade going forward.
John Belton, portfolio manager over at the Gabelli Funds, as we march to the closing bells, a record high for the S&P 500 and SpaceX earnings after the bell.
The closing bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick taking you through to that closing bell with a global simulcast. We're joined now by Carol Massar and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, television, radio. Our partnership with YouTube, a broader market. Carol Massar, at least with the S&P 500, set to log its first record high since June 2nd. But we're keeping an eye on earnings from AMD and from SpaceX.
Yep, those are the two big ones. SpaceX right now still up about 9.6% ahead of that earnings release, our quarterly update, if you will. It's definitely a risk-on trade, but there's a lot at stake. Investors want some specifics when it comes to SpaceX's business. We'll see whether or not we get them, and we'll see what kind of mood Elon is in. As Max Chafkin reminded us, sometimes it's upbeat, sometimes it's not.
SpaceX not the only company reporting after the bell, but it's certainly, I think, fair to say the most highly anticipated one. We'll hear from AMD, we'll hear from Paramount Skydance. Booking Holdings will give us some sort of potential view on how travel has been and how we expect travel will play out for the remainder of the year. And Viasat, interestingly enough, a competitor to SpaceX's Starlink business, is reporting too.
Yeah, I do want to point out, though, I was taking a look at the implied market moves and all the companies that are reporting earnings. AMD, an implied move of about 8%, which is high. SpaceX right now, implied market move after the bell, or tomorrow in the CAS session, 15% here. And of course, we talk about a company that's not only going to be driven, a stock that's going to be driven by the earnings, but the idea that with about 640 million shares now available for trading, keep in mind, in 2 days, you're going to add as many as 911 million more shares to that, and that seems to be where some of the concern. Short interest now well over 200 million shares. Record high for the Dow Jones Industrial Average here on this Tuesday afternoon, up more than 900 points or 1.7%. A record high for the S&P 500, up 1.8%. The Nasdaq Composite up about 2.6%. The Nasdaq 100 up 3.3%, and the Russell 2000, Carol Master, closing out the day 1.9%.
All right, as we wait for SpaceX, booking is out, and let's get to the outlook. The company says it sees third quarter revenue at constant FX up 5% to 7%. Third quarter gross bookings up 4% to 6%. And now we have Paramount out as well. Yeah,
Paramount Skydance now out with their earnings as well. For the most recent quarter, the company did say that year-over-year revenue did rise about 16% to $6.91 billion. That looks like a beat. It looks like on the bottom line also a beat as well. Here's your forecast for the full year. The company says expect total revenue of $30 billion. It says expect EBITDA of $3.8 billion, which actually looks a little bit light. And for the current quarter, the company says revenue 6.95 to 7.15 billion. That's the range on Paramount Skydance.
Looking at some highlights here in the investor letter, the company said that second quarter was the best quarter for retention in Paramount Plus's history. It was powered by Dutton Ranch, UFC, and of course the FIFA World Cup non-exclusively across 6 countries in Latin America. They gained about 2 million new Paramount Plus subscribers in the quarter, now 81.6 million worldwide. The company too says it's raising its full year 2026 outlook, as you mentioned, to 3.8 to 3.9 billion in adjusted EBITDA.
All right, guys, Amgen, let's go to that. Second quarter adjusted EPS, $6.29 a share. That is a beat. $5.62 is what the street was expecting. Let's go to the outlook. Amgen seeing fiscal year revenue of $38.2 billion to $39.4 billion. That is above its earlier estimate of $37.1 to $38.5, and sees fiscal year adjusted EPS of $22.30 to $23.50 a share, and that is above its estimates. And you're seeing shares of Amgen, which are already up about 19% year to date, now with a gain of about 1.5%. SpaceX, that first number coming, the second quarter revenue, $7.8 billion, and that is above the estimate of $6.81 billion.
Absolutely. Here, we're going to wait for some of these other numbers to trickle out. This is going to be a complicated report. Remember, we're basically talking about 3 primary businesses. There's space business, which is effectively the launch, the connectivity business, which of course is Starlink, and the AI business. And a lot of people not only want to see what it did on the quarter, but more importantly here, what type of long-term forecast the company will give with regards to that. Also, Tim, obviously the idea of where we might go with regards to a more of a mashup. A lot of speculation about what could happen with Tesla, whether that gets absorbed into SpaceX, and the idea here as to what sort of deals and partnerships SpaceX can actually announce to keep investors placated in the short term. We got a little taste of that just a few moments ago, Tim, when they announced that they are partnering with Nvidia to use Nvidia's Rubin chips here on these orbital data centers that it's trying to build out.
Yeah, that's the StarMind AI-1 satellite compute payload. The company partnering with Nvidia to design the satellite compute payload. I want to remind people, too, that connectivity business is the vast majority of its main business in terms of revenue. In 2025 for the year, 61% of the business was connectivity. That includes the enterprise and consumer versions of Starlink. Space accounts for about 22% of the business, and AI, as of 2025, was about 17% of the company's revenue.
Another headline coming, SpaceX second quarter AI segment operating loss of $1.26 billion versus an estimate that the street was looking for a higher number, $2.39 billion. Right now we're seeing SpaceX shares, which rallied big time today, just up up about 0.8%, Romain.
Absolutely, and these numbers continue to trickle out here. The company says that EBITDA in the most recent quarter, $3.5 billion. That's well above what the street was looking for $2 billion. Again, that's for the company as a whole. It also says that it reached 12 million Starlink subscribers at the end of the second quarter. And here's your CapEx number, which of course a lot of people are paying attention to, $18.37 billion, basically $18 billion in CapEx. Now, that's backwards looking. That is for the second quarter. It'll be interesting to see what the next couple of quarters look like here. The company did say that it did end the second quarter with $100 billion in cash and cash equivalents.
Yeah, the estimate was actually for higher than that. The estimate was for $18.6 billion. Some other numbers to highlight here. SpaceX reached 12 million Starlink subscribers at the end of the second quarter. As you mentioned, the AI segment operating loss, $1.26 billion. The estimate was for a loss of $2.39 billion. Shares bouncing around in the after hours. Now just down about 1.3%, but shares surged in today's trading session, still off quite a bit from that high earlier this year. The estimate for second quarter Starlink subscribers was 12.19, so that was within expectations. The company also expecting that Cursor deal to close this quarter, that is the third quarter of the year. Once again, these headlines are continuing to trickle out. SpaceX shares down just by about 2.6% right now.
Our team putting its first story out on the Bloomberg. SpaceX's revenue exceeded Wall Street's expectations in the company's first quarterly financial report following its blockbuster IPO back in June. The satellite, space, and AI conglomerate reported revenue of $7.8 billion, greater than the $6.81 billion that analysts polled by Bloomberg expected on average, unveiled an operating loss of $1.26 billion from its AI business, better than the consensus expectation for a loss of $2.39 billion. But we should point out it was the largest IPO. We've seen quite a roller coaster after a couple of days initially out of the gate when it IPO'd of moving higher. We've seen the stock pull back, and short interest has been very high. And that is something to keep in mind as this company goes through the release and the analyst call to see what kind of short covering if the news is really upbeat.
Well, that's what I'm curious about, too, is how much of the share price reaction today is even going to be actually tied to the earnings themselves. I think it's over 200 million shares were shorted just coming into today. My guess is that number went higher as we got closer to this earnings report. You have 600 plus million shares now out there floating around, and you have a lockup expiry in 2 days that's going to potentially add 911 million more shares. Not to mention, you get almost double that when you get towards the end of the year. So that's going to potentially put some downward pressure on this stock. But of course, a lot will depend on the conference call, which kicks off in about 30 minutes time. And we're going to hear from Elon Musk, and he's going to have to say, look, I got a plan. Either you believe me or you don't.
That's the Elon premium that Max Shafkin was writing about for the Business Week Daily newsletter earlier today. I also want to point out that we're seeing a relatively muted reaction as of now just to these numbers. Like you said, Romain, a lot of it will likely come on the call. And going into, as of this morning, the options market was pricing a move of upwards of 14% to the upside or the downside. Getting a little more information from the company about the most recent quarter, government contracts, interestingly enough, $6 billion in multi-year U.S. government contracts. That's for Starshield, our own Dana Hull reporting. SpaceX shares up right now by about 1%.
And let's not forget Lauren Grush, who wrote a preview and covers this company and the space industry, said, what's really important is getting also updates on Starship specifically. Are there any technical setbacks? Because this is certainly key in terms of getting satellites out into the suborbital, or they've only been suborbital, but getting them further out. And that's part of the idea of getting either data centers in space. But this is so important, certainly, to the company's story going forward. All right. Right now, folks, shares of SpaceX just up about 1% in the aftermarket. That is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals covering those earnings out from SpaceX and more. Remain continuing there, of course, on the close on Bloomberg TV. And Tim and I back here on Bloomberg Business Week Daily on radio and more. We will see you again, same time, same place tomorrow.
Our coverage of SpaceX's earnings, its first earnings report as a public company, continues. On the revenue side for the quarter, for the full company, $7.8 billion in revenue. Here is how it actually breaks down. On the connectivity business, the segment revenue there coming in at about $4.29 billion, well above what the street was looking for. On the space segment, it does look like net sales came in at $962 million, above what the street was looking for, on average of $873.7 million. On the AI segment, its third large business as part of this company, $2.56 billion. The street was looking for $2.0 billion. Of course, this is still a money-losing company, with the SpaceX segment reporting an adjusted EBITDA loss for the quarter. But of course, we have to get to that conference call to learn a little bit more about what the future holds for Starship, and more importantly, for how Elon Musk puts all these pieces together into one coherent company. Ross Gerber joins us right now, co-founder, president, and CEO of Gerber Kawasaki Wealth and Investment Management. And Ross, I don't even know how much usefulness it is to even go through some of the numbers on a quarterly basis, backwards looking. I know a lot of investors are looking to figure out kind of whether Starship sort of fulfills that promise, and whether what's going to be attached to these rockets, presumably whatever sort of servers and other sort of orbital data center type of equipment, are going to be along for the ride sometime soon.
Well, I think it's going to be sooner than what people think, judging from the last Starship flight that we saw, which I would consider pretty successful. And when you look at the size of this thing and the fact that they're now getting it in and out of space without exploding and landing pretty well into the water, we're pretty close to having a reusable massive rocket ship, other than many of the technology challenges that they still face to get this to work, let's say, over and over again in scale. But just the fact that they've gotten this far is very encouraging, and I don't think people should doubt whether or not this is actually going to happen. It's just when.
Yeah, and I think that seems to be the consensus, and we've certainly seen some degree of a proof of life with regards to that ship. The question, though, becomes in terms of monetizing this further beyond just being sort of a taxi service, if you will, into space. How much of this gets monetized by SpaceX itself with regards to what it's able to put there, and that flows back into the company for its own coffers?
Yeah, and I thought it was interesting because I thought the most important announcement from SpaceX was their deal with Nvidia to build these, they're calling them Starmine data centers in space. So really they're putting the hardware pieces together to do something that's never been done before, which works because they have Starship and they have Starlink. So by putting the data centers in space, it really adds a whole new element of what can be done through Starlink, as far as not only just connectivity and internet access, but also sending and receiving data. So it's a very exciting, idea or premise to be able to do this, and only SpaceX can do it. And I think that's what makes this investment compelling. Isn't really what it's doing today, but what will this look like in 5 years? And it could be pretty damn impressive.
Were you surprised that they would make that announcement on with regards to Nvidia and using those Rubin GPUs?
I wasn't surprised because they have a very close relationship with Nvidia. What I'm surprised about is how rapidly they're moving forward with the development of these satellite-based data centers, which, obviously has never been done, and is the challenge from a technology perspective is massive. So they're moving forward full speed ahead, and I think it's a really exciting prospect, and it's a high risk investment because obviously all these things can fail, but on the other side, it's a high reward investment if they succeed. And so I think investors need to weigh both of those cases when looking at the stock today. But considering it's trading below the IPO price, individual investors who want to buy the stock certainly are getting it at a discount compared to everybody else.
Let's talk about the AI business, obviously created after you merge xAI with SpaceX. We should point out they're also saying in the release that they do plan to close the Cursor merger sometime this quarter, in the third quarter. This has been a bit of a drag, and it seems like there were a lot of investors that would have liked to see SpaceX go public with just the launch business and the connectivity business, and not necessarily xAI. Are you comfortable with maybe what his vision is for how xAI fits into all of this?
Well, I've been xAI is a painful thing because I sort of think Tesla should have owned xAI, and I know Elon didn't want Tesla to own it because he didn't control Tesla. So, well, he does, but shareholder-wise. And so xAI is a part of SpaceX. But the way I look at it is Elon is really good at building factories in AI, and xAI is going to be successful whether they use the compute or sell the compute. And so the fact that SpaceX or XAI is investing, billions of dollars into building these data centers, it's going to pay off one way or another because the demand for compute is so much larger than the supply of compute. And Elon's super good at this. So, I think investors are so short-term minded to be worried about CapEx during this incredible technology boom period. We would need the CapEx to be spent if we're going to be competitive, and that's exactly what SpaceX is doing. And I think if you take XAI out of the business, yeah, it's more profitable, it's easier to sell on the short term, but on the long term, you're missing one of the great opportunities to be able to provide compute from space, which is actually potentially massive as far as an opportunity. So, I think it should be part of SpaceX, and investors just have to be patient and let this stuff play out.
Starlink coming in, 12 million subscribers at the end of the second quarter. It's only profitable business. The company says it has ARPU for Starlink of $66 for the most recent quarter. This is kind of the one part of the business that doesn't really have to prove itself. I am curious as to whether there is a growth story for Starlink, or has it already sort of matured?
Oh, no. Starlink is just beginning in so many ways. Starlink is a critical system, and pretty much everybody in America should have it as a backup for their internet access. As a fire survivor of the Palisades fire, Starlink saved us. Without Starlink, I can't even tell you what would have happened during that fire. So it's literally a life or death critical system, and you should have it as your backup internet. So there's a massive market even in America that doesn't have Starlink. And then when you talk about globally, it's huge. But there's another element to Starlink that people have to understand, which is the military element to Starlink, which is one of the reasons Ukraine is having so much success with their drone attacks all throughout the country of Russia, is because they now have Starlink satellite antennas on the drones, and same with the US drones. And by doing that, it gives us a guidance system that's global, that can be managed anywhere in the world, and it creates a weapon that is almost unstoppable. And we're seeing this right now in real time. And this is due to Starlink. So the military side of Starlink is only also just begun, because we haven't even built that many drones yet. If we're going to be prepared for the future of combat and war into the 21st century for real, Starlink is going to be just a critical element to our military and our success in this new autonomous, military world. So Starlink is just at the beginning, whether it's, internet service on a boat, or a backup service at your house, or putting it on a drone to go blow up the wild berries factory in Russia. This stuff works incredibly well, and I just, there's no competitor.
Ross, always appreciate it. Ross Gerber, co-founder, president, CEO of Gerber Kawasaki Wealth and Investment Management. SpaceX shares now taking a leg lower, down about 7% in the after-hours trade. Meanwhile, Advanced Micro Devices, the chip maker, just reporting earnings. Its shares now down about 9% in the after-hours trade, providing third-quarter revenue guidance for the current quarter of $12.7 to $13.3 billion. Now, the low end of that range is above the average of street estimates. Let's drop back, though. Here are the second quarter numbers. For the second quarter, the company did report a beat on revenue, $11.5 billion. The street was looking for $11.3. Adjusted EPS, $1.66. The street on average was looking for $1.62. Operating margin did expand 27% versus a range of, 26.9 was the estimate, so pretty much on the nose. The CapEx number coming in at about $808 million. The street was looking for $299 million there. Back to the third quarter on that forecast, though, they are saying that they do see adjusted gross margin for the current quarter of about 56%. The street was looking for 56.2. I don't know if people out there are quibbling with a 0.2 of a percentage point on that, but the company does say that its data center sales will accelerate here in the second half of 2026. We're going to keep covering both of these big names as they both move lower, and we await for the conference calls of both to start. Our next guest, well, he's got ETFs, leverage ETFs for both companies, including tracking SpaceX since the IPO. Will Rhind, founder and CEO over at GraniteShares, joins us right now. He oversees SPAL and SNK, the 2 times long and short SpaceX ETFs. And Will, let's start with SpaceX here, and with regards to what we heard today and whether that moves the needle at all in either direction, to the long side and the short side, in terms of opinion on where this stock might go.
Yeah, it's interesting. I mean, the stock had a very good day today, obviously coming into the earnings, and probably the best day that we've seen for a while. Certainly from our business, I can tell you that the orders were almost exclusively skewed to the short side, meaning that people were buying SNK, which is our 2 times short. So that tells you that expectations were bearish, going in, at least from our perspective. That was to some degree backed up by the prediction markets, which actually last time I saw had the earnings at a miss instead of a beat. But of course, it's just the first day. I think there's a bit of nerve still around what's going to happen later in the week with the lockup expiring, and certainly a lot of shares available to be sold for the first time. So I think it was less about the earnings today and more about what's coming in the next few days.
Well, I'm curious, how do you think the lockup is going to affect? I mean, we've been talking about this a lot on the show. I mean, 600 million shares right now out there trading around 900 million more shares being unlocked this Thursday. And there's been a lot of discussion that there's not a lot of optionality for some of these insiders, given when they bought in and what they're sitting on. Some of these folks have to sell.
I think that's right. So I think sentiment, you'd have to say, is skewed negative here. That being said, because we've known about this, you have to ask yourself how much of this is already priced in to the stock movements, and therefore it might be a surprise to the upside. You just never know. But I think you'd have to say, based on all the evidence, that you have a lot of investors who bought into the company at valuations significantly lower than even today's, of course, and it would be an opportunity for them to sell, which you'd have to think would put pressure on the price.
Well, I'm curious, what is the price to even short this? Because I mean, SNK, the last time I checked, correct me if I'm wrong, you're charging like 2.25% on this. And I mean, I've seen, we had Bob Sloan on the program on the network earlier today talking about the cost of just straight hedging on the shares itself here. Is it going to become too expensive to even bet against this stock at this point?
I think there's always a price. We've seen that for other stocks, and certainly stocks that are way more volatile than SpaceX even, that typically the market finds a way to source supply, even if it is at a very high cost. The cost for something like this, isn't that bad at the moment because it's a huge mega cap stock. So there's quite a lot of supply available. That does obviously change with certain other names in the market and is very much supply and demand driven, of course.
I do want to ask you about AMD. You also have a product there, the AMYY, and those shares also getting hit pretty hard here in the after hours trade. Give me a sense here, kind of like what people wake up to tomorrow with regards to sort of, how they sort of trade in and out of this, whether it's through your ETFs or through the stocks themselves.
Well, I think the first thing to point out is that there's been a lot of volatility this earnings season in particular. And of course, we've just come off the back of a very brutal month, which is July, for momentum stocks, particularly a lot of the semi stocks. Of course, I think it was the worst July for the NASDAQ for 22 years. So in that environment, you've had earnings, the Google earnings, for example, spring to mind, where, for all intents and purposes, the numbers were amazing, but with slightly higher capex than the market expected, the shares took a dive and subsequently, recovered. And I think we've seen that playbook in past earnings. And I think what we might be going through with AMD right now is similar. I haven't had time to digest the earnings as of right now, but I suspect it's a little bit of an overreaction to perhaps a number that was, or the market had priced to perfection, that maybe there was some detail off. But the one thing that we typically see in the business is we see a lot of activity, people trading in these levered ETFs in the pre and post market. So we get activity coming out of Asia overnight. And that's the great thing about a lot of ETFs, which not everybody knows. You can trade in the pre and post markets. Yeah. So before the official sessions start. And when we see moves such as this, whether it's AMD, whether it's SpaceX, whether it's SK Hynix, you typically see a lot of interest even before the official session opens, of course, when the market opens in the morning.
Well, I do have to ask you, Will, though, about some of the critiques of some of these leverage ETFs. And, I mean, we saw the sell-off that happened over in Asia, a bit of an unwind there. There's been criticisms of funds like yours that basically the way that you have to rebalance, in a lot of ways, you are actually moving the very stocks that you track. And the SEC has also put out warnings. Goldman Sachs has said this could potentially create systemic issues should it continue apace. How do you respond to that?
I think that leveraged ETFs, if we just talk about that specifically, have been around for almost 20 years now. This is not a new phenomenon. And of course, like anything that's supply and demand driven, we have a free economy where investors are free to decide whether they want to buy a leveraged ETF or an unleveraged ETF. And, there's clearly demand for trading vehicles. There's investors of all types, investors that want to buy and hold and are conservative and want to, execute strategies for the long run. And then there are investors who want to execute strategies for the short run. And to me, neither is right or wrong. It's very much about how you express yourself individually. And, one thing that is obvious is that there's demand for trading. There's demand for trading tools, and that's where leveraged ETFs play their part. They're not for everybody. They're not for buy and hold investors, but for trading vehicles, they play the role very well.
Will, always appreciate it. Will Rhind, founder, CEO over at GraniteShares, as we continue to keep an eye on SpaceX with their conference call set to kick off in just about 5 minutes' time. We're going to hear from Elon Musk, his first earnings call since SpaceX went public, and analysts are certainly likely to press him on the AI business and the massive spending associated with us. Joining us right now to talk about the leader of this company is Steve Wesley, a former Tesla board member and the founder of the Wesley Group. Steve, thanks for joining us again. I am curious about sort of, what you think Elon is going to try to articulate on this conference call. A money-losing business, but obviously a ton of potential up ahead for what this business can be. There is a salesmanship job that has to go on, not just today, but probably over the next few months and quarters. You think he's going to be able to do it?
Well, he's a pretty darn good salesman with a pretty strong track record. But look, I think this is going to be high drama because the share price down 13% from the IPO, but down 50% from its peak. So they've got their work cut out for them. I think what they're going to argue here is, look, they're an incredible growth engine that SpaceX on track to double from 18.7 billion 2025. This year looks like they're going to hit 38 billion. And I think he's going to say we're probably going to double again next year. He's going to focus on being a market leader. SpaceX is dominant in launch. 51% of all launches in the world are SpaceX craft. Starlink, very profitable, growing 80%. He's got a good growth story. But I think investors are going to walk away with 3 questions. How quickly can SpaceX and Starlink continue to grow? Can SpaceX AI really break in with the big boys, Anthropic, OpenAI, and Google? I think they can, but that's going to be heavy lifting. And then the third point that most people aren't talking about a lot, but this is a bit of a different IPO where shareholders can sell 20% of their holdings within 90 days tomorrow. And so one of the questions out here is going to be, how many people are going to hit the exits early? A lot to unpack. It's going to be interesting.
Yeah, and it's the 20% obviously this week. I think you get 28 to 30% more after the Q3. So this is going to be something that's going to dog this stock for a while. But give me a sense here. I mean, you sort of rattle off the businesses themselves, and no one's doubting Starlink. I think Starship, despite some of the hiccups, most people, the consensus is that this will sort of come through to full fruition. I think some of the concern has been about Elon bolting on a lot of other things. So let's just take XAI, a $1.3 trillion valuation for a money-losing company. What is an investor betting on if they have to take in XAI with it? Where does XAI fit into this into the total equation?
Look, AI is the fastest growing sector of the global economy. No one has ever seen anything like Anthropic and OpenAI before. Musk is saying we can play with those guys, and I think they're showing the initial steps to do that. But it's going to not be cheap. They're talking about losses are growing from 15 billion a year to 30 billion a year. Some analysts are saying they might burn through as much as 300 billion before the end of the decade. So he's going to have to show rapid growth in the number of users. He's going to have to show they can sell into both the individual and the B2B market. This is not going to be easy. I dare say, I think it's a lot easier to beat General Motors and Ford in the electric car sector than it is to tackle Anthropic, OpenAI, and Google. So we'll see if he can do it. You hate to bet against Elon Musk.
I have to ask you about Tesla itself, because there's a lot of speculation that at some point Tesla might ended up getting folded into SpaceX. You know this company from its startup days. It's obviously struggled as of late a little bit, but then I think about Grok. It's in Tesla cars. Starlink, I think, is part of the Cybercab. There's a shared chip fab in Texas. I mean, you add it all up. Those are just three things, Steve. I mean, come on. It's not far-fetched to think that at some point Musk will just wake up one day and say, wait, we're just going to do this. And he'll do it at 420, I'm sure, somewhere.
Look, at 420, there you go. Now, look, I mean, he all but said in the last annual meeting that there are, quote, many collaborations with SpaceX, especially with Tesla, especially TerraFab. And look, the number of synergies here is huge. There's synergies on chips, memory, compute, especially on energy. Now SPX Colossus uses microgrids powered by Tesla Mega Packs for load smoothing. Keep in mind, we're in the time of the greatest energy demand increase in history, and Tesla's one of the biggest battery sellers in the world, energy companies. So there are a lot of synergies. It would make this combined entity of SpaceX and Tesla the largest firm in the world almost overnight. I would guess that would be nearly irresistible to him. But the big questions are, would regulators approve, and would there be complicating issues like would Tesla be forced to divest their Chinese factory, which, by the way, produces just over half of all Teslas. So a lot to unpack. These are not easy things, but yeah. I can tell you more than a few people are thinking about that one.
I am curious. I mean, you joined Tesla when it was still a private company, and there was a lot of pie in the sky predictions about what it could do. Running a public company, running a private company with the ambitions of long-term projects that could take years, if not decades, to complete is a lot different than running a public company where every quarter you're going to have a bunch of folks on Wall Street demanding answers here. So when I hear Mars and humanoid robots and the data centers in space, I mean, that's not happening this year. It may not be happening next year. Do you think that investors will give him a long enough leash to sort of get to those sort of multi-year, maybe even multi-decade projects?
So that's the big question. Look, in the early innings here, people are excited. They want to be excited. This is someone who is perhaps the greatest entrepreneur in history, and he's got a pretty decent, not perfect, but a pretty strong track record of accomplishment. So a lot of people are pulling for him. But no investors, patience is eternal. And so they're going to be looking at Tesla, they're going to be looking at SpaceX, they're going to be saying, are we hitting the numbers? And I think we're all going to start to understand how many satellites does Starlink have? Right now, it's just under 11,000. How long is it going to take to get to 20,000? How many users do they have for broadband usage? How many people are using XAI instead of Android or Anthropic and OpenAI? Everybody is going to be tracking these numbers like crazy, and Elon, over time, is going to have to produce like anybody else. And the numbers to track are, how fast are they growing? Right now, pretty darn fast, 100% year over year. The next question is going to be, what's that path to profitability? If it's $300 billion burned, that's going to test investors' patience. We'll have to see how it's going to all shake out.
Steve, appreciate you taking time for us. Steve Wesley, former Tesla board member, now founder of the Wesley Group. As that conference call kicks off, the shares remain under pressure. And a lot of focus, of course, on the AI business, but ultimately the crown jewel of this company. So much of Elon Musk's plans hinge on the success of Starship, of course, the massive, fully reusable rocket that is in the late stages of development. Our next guest is a leading expert in the aerospace sector, designing technology for NASA, the Jet Propulsion Laboratory, the U.S. Air Force, the U.S. Navy. She joins us right now. Sinead O'Sullivan, economist and former senior researcher at the Harvard Business School's Institute for Strategy and Competitiveness. Let's talk about Starship, Sinead. And I am curious. I mean, most investors seem to have relative confidence that we will see this in full force sometime soon. You understand the technology. Are we there?
We are not there yet. Now, your previous guests have brilliantly outlined that what Elon is really good at doing is selling stuff. We have also seen that Elon is also very good at building and manufacturing stuff. The one thing I would say about Starship that should leave some people with a few more questions in their mind, let's just say, is the sheer complexity of what they are trying to do with Starship versus their former, the current rocket that they're using to launch, the Falcon rocket. So, I think what we're going to see and what we're starting to see is engineering slippage against timelines and budgets starting to become overrun, which is the one thing that we know Elon is typically not known for doing. And the reason being that the level of complexity of Starship is categorically much, much larger than the Falcon rocket. And so it's going to be really interesting to see if we can look at that R&D timeline against NASA's expected timelines, but also their internal timelines to see whether or not they're going to be able to stay on track for not only their own expenditure on the capex, but also to be able to start delivering much needed revenue gain in terms of Starlink and other projects.
Is there any risk? I mean, there's been a lot of talk about that they need to sort of prove Starship's commercial viability, I think by next year, if they're going to participate in NASA's Artemis 3 mission, which is effectively, us going back to the moon and I presumably beyond. Is that sort of the deadline that we're looking at right now?
That is certainly a deadline. Now, NASA has been pretty strict with SpaceX, and they're not getting any special treatment here. They've kind of said if there's slippage on this timeline, the revenue that you're going to get from the government in terms of the Artemis and the space projects that you're doing through NASA is going to be taken away from you. So there certainly is a real risk here that SpaceX is going to want to stay on track here. However, in terms of the revenue that they're actually going to get for the Artemis missions, it's really small compared to the other business units that they have. It's a fraction of what they would try to get, let's say, in the AI or the returns that they would need in the compute space. However, where the Artemis project is important for SpaceX is strategically. Now, a lot of the mission and the vision around this company has been built on his kind of very long-term desire to go to Mars. He pulled back on that recently and kind of said, I'm not sure Mars is actually the mission and the goal anymore of this company, and kind of reiterated that, the moon and the Artemis project is a much better vision. And even then has kind of pulled back on that more recently to say, we wanted to increase civilizational and human reach in space. Maybe the way to do that is with orbital data centers instead. So what I would kind of be looking for here is, if we are seeing the mission and the vision changing so quickly coming out of SpaceX, what are we to be looking for in terms of engineering and R&D? And if we're seeing the goalposts moving, which I suspect they are, from Elon's personal motivation, and he's not that interested in space exploration anymore, where is that going to be reflected in revenues? And I think the move to orbital data centers and away from kind of Artemis NASA missions is going to be important. Strategically, they will want to stick to those timelines, though, because they kind of need to. The burn rate for Starship development is $3 billion or more a year.
Wow.
For a company that's fairly loss-making at the minute, that's not nothing.
Yeah. Well, what exactly ends up being the end result here? I mean, I know in the past Musk has talked about this idea that he wants a Starship rocket basically launching every hour, which, worries me for a lot of reasons. But also, what exactly are we taking up? Do we need that much stuff going up every hour? I mean, maybe I'm just, from a different generation where, we had, seemed like a rocket launch once, every few months. But, that's a lot. And I guess, and I don't mean to be glib about it, but I'm looking at it more from a cost effectiveness, accretive to the bottom line. Is that type of launch schedule, if he is indeed serious about that, is there enough demand for the product, for the service, I should say, to justify that?
This is such a good question, because what we always hear about in this industry is Elon's vision vis-a-vis supply. I want to send rockets every, X days, hours, minutes, whatever he thinks about that morning. It becomes kind of, the next strategy in place. However, let's actually look at what demand is driving this. And very interestingly, ultimately you have SpaceX at the minute delivering the vast majority of launches, US launches, and certainly global launches are a lot of them are going through SpaceX. However, what we've seen, the entire industry was kind of, as it moved out of the government and into this kind of commercial stage, was predicated on the cost of launch falling through Falcon's launch, which was going to kind of create this boom in demand. What we saw was that the cost of launch fell, but the price to the customer did not fall to the extent that was expected. Mm-hmm. And what we saw in return was that the demand did not increase as analysts once expected. So when you look at the demand for launch at the minute, most of SpaceX's launch is for its own services. So, I guess the question is Elon going to be able to generate the demand downstream to justify Starship launching as often and as much cargo as
I think we lost Sinead's connection there. Sinead, I do have one last question before we let you go, and this has to do with the idea of the singularity of what Starship is and what it represents, and whether you, as a scientist, believe that there could be any sort of meaningful competition to it. Right now, Falcon 9 for a while was the only game in town. Assuming Starship makes it on the timeline, it will be the only game on town for a while. But there are a lot of other companies out there that think that they can actually be a player in this as well. Do you see the potential for real competition in this space?
It's really hard to say. I think, Elon Musk started really early and he got the full support of the US government. And now he's been able to create essentially a monopoly in this space. It's going to be really, really hard for a competitor to steal enough of that market share to make their own economics work. But again, let's not forget, Elon also created his own demand. So a competitor is not only going to have to steal market share from the Falcon or Starship launch vehicle, they're going to have to get really good at generating their own demand to make the economics work. And we still haven't seen any of these actual economics from the launch services yet. If they were profitable, we probably would have heard this before. So we don't even know if this segment by itself is ever going to be profitable. And this will ultimately decide whether or not a competitor wants to compete for what is ultimately a loss-making exercise.
Sinead, really great to have you here, really insightful. Sinead O'Sullivan. She's an economist and former senior researcher at the Harvard Business School's Institute for Strategy and Competitiveness and worked at NASA, the Jet Propulsion Lab, and other places there. As we continue to watch SpaceX shares under pressure as the conference call gets off, the downdraft in those shares in the after-hours trade, dragging down some other names as well. AMD did come out with its earnings. It did beat, and it did actually guide slightly higher than estimates, though there was a bit of concern about margins as well as the CapEx spend. Those shares down about 8%. Dell, Marvell, Intel also moving lower in sympathy as well. We do want to talk a little bit more about data centers, and maybe data centers right here on Earth, because that's still where we're building them. So we want to dive a little bit deeper into some of those CapEx figures that we just heard. SpaceX's second quarter CapEx coming in actually below estimates, while AMD's well above estimates. John Medina joins us right now, Senior Vice President, Global Project and Infrastructure Finance over at Moody's Rating. All right, John, where do we stand right now? Because it seemed like if we spoke to you, a few months ago, it seemed investors were pretty comfortable with all of the borrowing that was going on to build out these data centers. Certainly in the last few weeks, there's been a bit of a rethink of that. We've started to see some spreads widening. And I was just doing the math earlier today on the Bloomberg terminal. The vast majority, 75, 80%, of the data center securities that have been issued since the beginning of last year, are now trading wider than at issuance. What does that tell you?
Thanks, Romain, and that's a good question. And part of it has to do, I think, with not just market changes, but also where we are in the timing of the year itself, right? So a lot of these new projects that came to market were in the first half of the year. So a lot of new capital was deployed, a lot of new investors. And so that's hitting the secondary, that's hitting different markets. And so you're seeing that kind of work its way through the broader market. And in the second half of the year, often those allocations are already allocated, right? So capital can become tighter, spreads may widen just because people have already deployed what they were allowed to invest for the year in that one sector. And so you'll see kind of probably the same thing happen next year and the year after, because we're looking at a multiple year build out cycle here. So I think the widening of spreads and tightening of spreads is probably going to continue for several years, just depending on the sentiment. But the train moving forward in terms of the need for capital and the need for more capital will continue.
What's that cost of capital, though, look like going forward?
I think the cost of capital does depend on the risk. You're seeing, I think, different names, associated with certain spreads. I think we are seeing a higher spread risk. Particularly there was one deal that priced, I think, at 7.5%, going out to 2045. A similar deal, was much in April, also 7.5%. We've seen things in the 6% range. Recently, a deal priced in over 9%, right? In terms of its tenant was a below investment grade tenant, so those will price even wider. But usually data center ratings, data center spreads and credits tend to be in the 6.5%, 7.5% pretty consistently. They kind of go up and down. And when you're outside of that range, there is a reason at a much lower risk or potentially higher risk.
Well, with regards to some of the debt deals, the collateralized debt deals, I mean, there has been a lot of talk about the payments that you're making relative to the repayments that you'll have to make on whatever revenue is generated from that. There's been a lot of talk about the value of these GPUs declining and creating a mismatch with regards to what's being taken in and the value of what you have and the value of what you have to pay back.
So it's interesting in the GPU financings, we are seeing an increase in those, and you'll see some of those come to market soon as well. They are borrowing over a period of time that's within the lease that's coming with the hyperscaler tenant, right? So 5 or 6 years, you're not seeing really an extension beyond that, but there is that risk of the data center that maybe has a 15-year lease with that same tenant that only has a 6-year revenue lease. So they have to renew that or find another tenant, after that first 5 or 6 years in order to continue to pay under their 15-year data center lease. That is that mismatch that you're talking about that we do see in some situations.
What about the hidden risk? A lot of people will say, okay, a lot of this is being done off balance sheet. You got SPVs, you got joint ventures. I've lost track of how many circular deals are being made where Nvidia sort of makes a quote unquote investment in this and then, of course, obviously ends up collecting revenue from that company in return. How much of that can you accurately assess when trying to determine what the true credit value or credit risk is?
When we're looking at these big companies, right, while they do have these forward leases, unfulfilled liabilities, I think it's up to 820 billion right now for the largest hyperscalers as of just about a few months ago. So a pretty large number, but that number also comes with revenue. So when we forecast forward, we forecast both the revenue and we look at that liability as well. And a lot of the revenue growth we've also seen in recent earnings reports, is increasing, right, because of this backlog of clients for cloud services and other services that are now being fulfilled. So you're seeing even a higher revenue growth that can cover that leverage. It can cover that long-term debt, those off-balance sheet liabilities. And so I will say our analysts are all in touch with each other, are keeping track, are looking forward to what is yet to be reported because we are aware of what's under construction, but are also, very conscious of the other side of that equation. It's not just a cost. There is revenue generation that is very much showing up now associated with these investments.
John, always a pleasure. John Medina, Senior Vice President of Global Project and Infrastructure Finance over at Moody's Ratings, keeping an eye on some of those debt financing deals to fund these data centers. Meanwhile, our next guest is pushing headlong into data centers, a growing data center backlog of about $1.6 billion on his book as his company expands to meet the power demand driven by AI. Aaron Jagdfeld is the chairman, president, and CEO of Generac, and he joins us right now. Aaron, great to have you here on the program. Anybody who thinks you're just, the guy you go to when you need a generator to, get yourself through a hurricane, obviously hasn't been paying attention to your company. You've made a big pivot into the data center space. You've gotten the certifications here. How big of a business do you think this can be for Generac?
Yeah, thanks for having me on, Romaine. I think you're hitting the nail on the head here. A lot of people have thought of our company historically as kind of a consumer goods company, and we have been for 70 years, selling generators and backup power into that residential market primarily. But we've been growing a commercial and industrial business over the last 40 years, and in fact, over the last 10 years, we've pushed very hard into expanding that business, a number of acquisitions, and we just rolled out, as you indicated, this product line that's geared directly towards larger format backup for the data centers. And it's going to be a big business. I mean, as you said, our backlog's at $1.6 billion already. The last 90 days, we've recorded over $1 billion in new business just in that, adding to that backlog. And we're working to triple our capacity there. We're trying to get close to $4 billion a year in capacity. And so I think when you step back, what we see in the future here is a company that's a lot better balanced, between our residential business and our commercial and industrial business.
Yeah, I mean, you've talked about, you and your executives, about a generational opportunity here that maybe you could even double your commercial business revenue in 3 to 5 years. But when I think about some of the large players, the large megawatt players, if you will, I think Caterpillar, I think Cummins, I don't know, Rolls-Royce, maybe a few others here. Are you able to compete with them now, or is this sort of a ramp up to be able to be better, more competitive with them?
Yeah, those companies have been in this space for a lot longer than we have in terms of the high end of the product range that serves this end of the market. We're new to it, but we've been in the commercial and industrial market, backing up hospitals and backing up cold chain distribution centers and water treatment plants and things for a long time. But this new product for us is going to compete head to head with those companies that you mentioned. And we're just bringing it online. So this year we'll ship about $450 million worth of product in that range, competing directly with those guys. And that's going to grow dramatically in the years ahead. As you said, we had, when we rolled out our investor day in March, we said maybe we can double this side of our business, the commercial and industrial side of our business. It actually looks, and that was going to be a 3 to 5 year plan. It actually looks like we might do that next year. So, in terms of just the uptake for this product line and the demand is incredible.
I mean, what are people using your generators for with regards to the AI centers? Are they using it truly as backup, or are we starting to see companies maybe run them kind of as a bridge until the electrical grid in those areas catches up with the actual build out?
Yeah, the products that we offer are specifically for emergency backup. So the grid goes down or their prime source of power goes down. Our generators start up and they take the place of that prime source of power. And again, these are the same products that you would see on other types of commercial, commercial applications, telecommunications applications, hospitals, and things like that. So there are bridge power solutions that are needed, right? I mean, the grid interconnect queues are growing at an incredible rate. And so we've got a lot of data center customers who are, they're providing some other behind the meter power source initially, maybe turbines, maybe even reciprocating, engine-driven gensets. But those are going to be temporary in nature. I think those ultimately, these customers are going to want to be connected to the grid. That's the lowest, kind of cost way to get connected to the grid. Most reliable source of power is going to be grid connected. And, backup power is an absolute must-have in these applications. You've got to have 5 nines of uptime in, any type of cloud compute or any type of AI inference learning type of situation.
Are you comfortable? And I know right now you're still early kind of in this build out, but I know you haven't named the customers, but it's still a small cohort of customers. Are you worried at all about some of the concentration risk with regards to this new revenue that you're generating? Do you have confidence it'll broaden?
We do. As you mentioned, we've got 2 hyperscale customers that we've inked deals with. Those orders are going to be forthcoming, and they're going to underpin a lot of our volume and our increase next year in 2027. But we've also been adding co-locators. So, smaller data centers. And when I say small, these are $100 million deals, $200 million, $300 million deals. So in and of themselves, they're very sizable customers, but they pale in comparison, obviously, to some of the hyperscale customers and in terms of what they can buy. But obviously, we want to broaden that out. It's like the #1 rule in anything in business is you don't want to have concentration of risk in anything, inclusive of your customer base. So there's going to be, there's a lot of developers out there. There's a lot of demand beyond the hyperscalers. We love the deals that we're putting together with these hyperscale customers, but the co-locators are growing quite quickly as well.
You are, by all intents and purposes, at least on Wall Street, pretty much valued now almost as an AI stock. But of course, with that, and that's definitely benefited your stock, but of course, with that comes a lot of volatility, as you've seen firsthand. You're comfortable with that?
Well, I mean, I guess as comfortable as you can be with volatility in your stock. I mean, the stock runs up to 290 and then comes back down to 200. Today, it's up, another $18 or whatever in one day. And you're right, that, this AI trade is choppy, right? I think there's a lot of things that are underpinning this in terms of the CapEx spending. You've been mentioning that on your program, and a a lot of other programs have mentioned this as well, is $750 billion of CapEx spending by hyperscalers in a single year. How sustainable is that? You get over your skis in terms of spending CapEx beyond your free cash flow generation. I mean, clearly that's not sustainable, but does it go from $750 billion down to $50 billion? Or is it something more like $400 billion on a go-forward basis? I think there's a lot of things that, that we're pretty early innings here in this build-out story. But I can tell you that all the conversations we've had, not only with the hyperscalers, but the developers themselves, is that at least for the next 5 to 7 years, what you're looking at here is a pretty massive build-out. And I think that, the AI trade, while maybe choppy, in the interim here, I think over time, and you've seen this, you've seen what Caterpillar's done, you've seen what Cummins have done, you've seen what Generac's done, you've seen the returns here. I think that that's something you can look forward to for the near term.
Hey, Aaron, really appreciate you joining us today. Obviously, a fascinating growth story here for Generac. We'll catch up with you soon, I'm sure. Aaron Jagdfeld there, the chairman, president, and CEO of Generac, as we continue to keep an eye on that conference call for SpaceX underway right now. We are hearing from some of the executives on that call talking about the near-term priorities in launching the mobile V2 satellites and, of course, what goes on with Starship. Joining us right now to talk a little bit more about this is Ed Ludlow, who I'm pretty sure has been listening in to that conference call. Ed, I mean, I've been saying this all hour. I mean, the numbers from last quarter are almost immaterial for a lot of folks out there. This is really about the long-term story. What are they articulating right now on the conference call?
Yeah, all the business lines have momentum, right? There are some kind of operational updates, which is that, right now SpaceX is benefiting a lot from the investment it made in its own data centers because it's renting out that capacity to third parties, namely Anthropic and Google. And so the AI division, while the spending is concentrated there, it is allowed for some pretty positive numbers on the bottom line in isolation on that unit. And Musk is talking about that being the direction of travel. They'll end the year with 2 gigawatts of capacity installed and that they will continue to ramp up from that point. Orbital data centers in space are on track to launch next year, and they've gone with Nvidia as the exclusive compute provider, something that broke just before the closing bell. But they basically explained they look at all the architectures and Nvidia's were the best, so they went with it. And that's a departure from their previous strategy where they said they'd look at all of the different compute platforms available, make reference designs, and pick the best one. They picked the best one. Other than that, the thing we don't have, forward-looking guidance, revenue, capital expenditures, but the CFO's talking.
The CFO's talking. Hopefully we'll get some of those numbers. On the CapEx side, how much does that matter to investors? I mean, when I look at some of the plans that Musk has laid out, I mean, it sounds like that's going to cost a lot of money, but it doesn't seem like you have the same scrutiny over CapEx that maybe we saw for the hyperscalers and some of the others.
Yeah, I mean, their liquidity position is they have $100 billion to play with, right, post-IPO and what they did in the debt markets. And the street thinks they'll spend $45 billion plus or minus this year. The compute side of it, what they're doing on Earth as well as what they hope to do in space is expensive. AI is where the spending will be concentrated. And it will impact supply chains, right? If they're going to be a big spender on Nvidia compute, there is a Tesla exposure because of the joint direction with Terafab. That's their shared chip manufacturing initiative. The spending will matter. The level of it will matter.
All right, Ed Ludlow, co-host of B-Tech there. We should point out that conference call still going on. You can type TLIV on your Bloomberg terminal to continue to see a live blog of that. We'll continue with full coverage on Bloomberg Television, even into Balance of Power. But as of right now, you see the reaction in the shares in the post-market here. SpaceX down about 7%. This after reporting pretty much what we knew. There is revenue growth, not necessarily profitability, with the exception of the Starlink business. Advanced Micro Devices, they were also out with earnings. They did beat on several key metrics. Their guidance relatively in line, but a few numbers came in light. That conference call also underway. Those shares down about 7%. A lot of names in the broader AI space being dragged down. We'll see if this flips into the cash session tomorrow morning at 9:30. But stick around right here on Bloomberg Television. A lot more coming up. The team at Balance of Power, they take the baton up next.